All right, welcome back. Here is the second video on the series. Then on the last video, we started discussing what is Forex, what is trading, who are those trading, who are you in the market. And then the first time we've dealt with all that. Then this time we are going to talk about the market itself and you, what you do in the market. Let's tell you one important thing. The relationship between you and the market is the money you are putting in and what you are exchanging it for. The marketplace is just an environment for you to carry out your transactions. And as someone who is there to trade, every trader must have what is called capital, right? Capital. Every trader must have what is called capital. The businesswoman who sells maybe rice and beans or whatever they sell around your environment, let's assume that their capital is something like this. Let's say $100, right? And they know that they are not just going to sell only rice, they are also going to sell other things. Are they going to make use of that $100 to buy just rice? No, they won't do that. What they will do is they will split it, all right? And they will also have what is called backup funds. In that case, they're going to have what is called backup funds. So what they will do is, out of this $100, what they will do is maybe take out 20 or $30 and go to the market. If it fails, they go back again because they know that things might happen. You know, what they are buying and selling might be perishable, whatever the case may be. So they are not going to throw in the whole money and then come back tomorrow and start begging for money again. No, they won't do that. So what they will do is they will take it bit by bit. If it returns profit, then fine. If it doesn't return profit, they go again because they are still liquid. Being liquid in this case means that there is still money with them. So maybe when we advance in this course and start talking of liquidity, you will now know what it means to be liquid. So they are still liquid because of what? They have money. That is what it is. So this is what is called your capital. So your capital can be $100. All right. Now, if your capital is this now, you go to the market. In that capital, you are going to risk some portion of it. That portion of it you are putting in at a time is called your risk. Your risk per time might just be $2, all right? Might just be 2 out of the 100. So capital is not what you are risking. You are just risking a fraction of the capital. And this, your risk, is what you are giving to the market. That is what you are exchanging with in the market. You've known what is called exchange. So the woman who carried rice, or maybe the person who carried yam from the house, going to the market to exchange it with another person, won't just carry everything they have because they might still need rice tomorrow. So what they're going to do is take a little bit of it, go for exchange. In case they never found anyone, or the rain were, they were beaten by the rain and the whole thing spoiled, are they going to come back home empty? Let it go. It's part of it. They go back again tomorrow, searching for another person to exchange with. So out of your $100, what you're going to do is take a fraction and risk. See, you understand that what you're doing now is you're risking just a fraction of your capital. Please don't make this mistake. Many people made mistakes because they didn't know these basics and they failed in markets and they called the market a scam. We tell you the market is liquid, it has money to give you and share, and it doesn't even know whether you're taking money or you're not taking money because you're just a passenger. Whether you decide to be in the market or not, the vehicle must move and go where it is going. So what do you tell yourself? You be wise and join and be a wise passenger following the vehicle where it is going. All right. So this is what is called risk capital, and this is what is called capital. Please make no mistakes about this. You must define your risk. You must define your risk and know what you are up for. You have to tell yourself this before you open the chart. Don't open your chart and then start telling yourself. Tell it to yourself. Know it that this is your risk. And how do you solve this? Okay, how will you know that you can risk in the market? How do you know that you can put in? Okay, let's tell you another thing about risk. Risk is this. This time you are spending watching this video is actually you risking your time. You wouldn't know whether you are going to get value or not. But if by chance you get some value from this video you're watching now, then it is profit unto you. But if after it, the whole thing is just, he was just talking blah, 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 and then it doesn't make sense. You risked it. You didn't make any profits. So life is about risk and reward. So when we talk of risk, the other side of risk is reward. What you are giving into the market, which is in this case $2, what are you expecting in return? What do you expect in return for risking $2? And then how do you define your risk? Okay, to define your risk, you need to ask yourself one basic question. You know who you are. How much of what you have now can you throw away every day and you will still live a normal life? Let's assume you have $100 and let's say your income every month is $100. Or let's make it daily. Let's assume your daily income were to be like $100, for instance. How much can you throw away from that $100 every day and you won't struggle? You will still live a normal life. If you can throw away $2 every day from that $100, then that is the risk you can bear every day. So on each day, you are coming to the market, even if you have $1,000 on your account, you are coming to give $2 to the market. If you lose those $2, you go home and live a normal life. It won't affect your psychology, it won't affect your existence, it won't affect your life. But if you throw away the $2 and you decide to throw in again, hoping to get more, you have broken your rules and you have crossed your risk threshold. The punishment is that your life will be affected. Everything you're going to do that day, if you don't control it, you might just be affected. Now, the person who has $1,000 or $100 in the bank might have need for water and will take some cents to buy water. Might just have need for clothes and then take some money to buy. But if any case he spends $80 on a stretch on the same day, what do you think he will do? He will feel it. So in trading, in exchange, only exchange what you can let go. Please do not exchange more than what you can bear. That is a risk and it is not worth it. So when we talk of risking, we are talking of that goods or those services you have brought to the marketplace to be exchanged for value, for profit. In this case, the only thing you are bringing to the market is money. Because what we are exchanging is money. We are exchanging foreign currencies. Remember what it is? Forex, foreign exchange. And the foreign there and the exchange there means we are exchanging foreign currencies. So whatever you're bringing to the market, you are dealing with money. That's what you're dealing with. So you're not going to buy peanuts here. You're not going to buy rice. You're not going to buy yam. No, what you're exchanging is money. So how much of money can you throw away every day in the market and you will not feel it? This mentality is not a mindset of a gambler. But what it does to you is that it makes you define your risk on time. There is a lot of time in the market. There are many currency pairs. There are many opportunities, but not everyone is coordinated enough to know when they have actually crossed the boundaries. So that is why you must know it. Your capital might be $100. How much are you willing to risk out of this $100 that you wouldn't risk and go home crying. All right. So when you risk the $100, what do you expect in return? What do you expect in return? Then we now talk of reward. That's where you hear words like R, R. All right. Risk to reward. Let me change this. So you see something like risk to reward. In a case where you talk of risk to reward, let's assume I was risking, in my case now, my risk might be $2, all right? Two. And then the reward I expect, let me put a W there so that, or let me put a K here so that you know we're talking of risk, all right? Then reward here. In this case, I might be expecting 2 times or 3 times of whatever I'm risking because it is profit, all right? So if I'm expecting 2 times of it, what should be my reward? My reward is going to be $4. If I'm expecting 3 times of it, what is going to be my reward? $6. If I'm expecting 4 times of it, what is going to be my reward? And I'm going to expect $8. All right. So whatever you're risking, have an expectation, because in trading you won't have consistent results until your expectations and actions are consistent. Please note this: if your actions and expectations are not consistent, you will not get consistent results. So you need to know what you are doing, and you need to do it well. You need to do it with proper understanding of what you expect in return. In trading, we can have 3 to 1, 3 to 1, 3 to 1 reward to risk. So you can say RR. You can have, we also have 4 to 1, 4 to 1 RR. All these are possible. All right. All these are possible. You can have some even up to 8 to 1. All right. You can even have up to 8 to 1 RR. It depends. 8 to 1 RR. All these are possible. All right. So anything is possible here. It depends on how you are trading. But in my own case, I prefer 3 to 1 and 4 to 1. And as we move on, we are going to tell you. Okay, so have consistent expectations. Know what you are expecting in the market. Now, I want you to ask yourself. I believe by now you should have gotten your pen or your paper where you're writing down these lectures. Now, check properly. You know what you're going to the market to do, right? You know what your risk capital might be. You might even decide to start with $50, $30, and all the rest. How much can you throw away every day in the market and you will not cry? Now, ask this question, answer it. Ensure that you answer this question. Be sure that you've gotten an answer for this question. How much can you throw away every day that you will still live a normal life? After throwing it away, you still live a normal life. And we know that that same money you're doing business with it, just like the businessman. All right. Those days, there are people who would go to the market, buy perishable goods, and then they have issues there. They come back, everything is shattered, their family is destroyed. In fact, their children, they cannot even take care of their children again. Issues, problems here and there. It is going on with traders. We tell you that it is going on. Many people came in with expectations, unrealistic expectations, because they never knew these things. So they came in, some of them will take their salaries and throw into the market, hoping that by tomorrow they are going to make so much money. Some tried it out on demo. It looked at it as though it worked. So they would want to go and do it with real money. And then when you go to real money, you see that the mindset is quite different from when you are trading on demo. We are telling you the truth. So what you do is define it. What can you throw away every day that you wouldn't cry? If you answer this question, you will discover that most of you can even throw away, you might not even be able to throw away $2 every day without crying. Some people might not even be able to throw away $10 every day without crying. So you see, and this is what you need. How much can you throw away? every day. So this is a question you ask yourself now. Decide it now. I call it risk threshold. That's what I call it. Risk threshold. What is the maximum limit of risk that you can take on the market? What is the maximum amount and level of risk you can take in the market? Answer this question by asking yourself, how much can I throw away every day and still live a normal life? Because whenever you come to the market, you're supposed to be normal. If you're not normal, you're not going to trade well. All right. So we are handling these things to ensure that you have the mindset of a businessman before you even come to the market. All right. So make sure you follow these videos one step at a time, because many people never knew these things. If they knew, they would have been better traders. All right. There is a lot of time to trade. You are going to have all the years to trade. And there is no point throwing away the whole money at the start and then going back to look for another money. We will see you on the next video. Ensure that you're following it serially, and each of them you have learned, apply to yourself and ask yourself questions. How does this apply to me? You've known what is risk. You have known what is a capital. So you're not risking all your capital. You are risking only a fraction of your capital. See you on the next video. Please make sure you subscribe and like and share these videos, because there are still other people who need these lectures. Don't assume that this person is a trader already. Many people never knew it. All right. So just share it. See you.